Hey guys, Mubarak here again of InPennyStock. Hope you're doing well. As always, we're doing this live for everyone only for this week at 8 p.m. Pacific, 11 p.m. Eastern. This is going to be the time where you guys can come through to ask your questions, any stock trading advice or investment tips you're looking for. I'm here to answer it for you guys. All right, our goal here at InPennyStock in 2020 is to become a lot more transparent, give you guys a lot more information, and give you guys more and more access to us, me specifically, and our support team, as well as the course. All right, we have hundreds of videos on our back end at InPennyStock University, and we try to teach new traders or new people looking to get into the stock market exactly how to make their first move. All right, so we're going to be offering this for everybody for about a week, and then Friday this week will be the last live to the public, and these one-on-ones will only be available and accessible to the executive VIP members at InPennyStock.com. So if you're interested, go check that out after this. But for today, what I want to cover is how to understand market depth. All right. So for a lot of you guys, you might not even have heard this term, or you might have heard it at times, and I'm going to kind of cover what that means today. All right. Market depth. Now, what that is essentially is exactly what happens when you're looking at an order book. All right. Basically, the order book or the market depth of a stock tells you how many people are buying the stock and how many people are selling it. All right. And there's a lot of important factors that will influence your trading based on how this is set up. All right. So I want to kind of show you guys what to look out for, how it'll look in your stock trading software. And actually, just to start about that, I want to tell you guys about how to get set up with your stock trading. All right. So the first thing you have to make sure to really understand this and follow along is to make sure you have a trading platform set up. So just kind of like real estate, how you pretty much have to go through a real estate agent most of the time to be able to buy. Though I know there's a lot of for sale by owners, which are more and more common these days. But essentially for the stock market, in order for you to buy or sell any stocks, you're required to use a stockbroker. All right, so back in the day, in the 90s and stuff, they used to actually have to call somebody and get their trades executed. But nowadays, with technology, you can just use online platforms like E-Trade, TD Ameritrade has a platform, Fidelity, Charles Schwab. Basically, whoever you bank with, you can ask them if they have a trading broker that they recommend if you want an easy bank exchange, in order to deposit your money. But basically, your brokerage account is your investment account. So just like you have a checking and a savings, this is a separate account where you put money into in order for you to trade. All right, but let's get into the main lesson, which is market depth. So what you're looking at when you're looking at market depth is how many people are looking to buy, that's the ask price, and how many people are looking to sell, which is the bid price. All right, so the interesting thing to understand here is when you're actually stock trading, that there's a little exchange of variance between what you get your offer in at and what you sell it at. And usually that's about a penny difference. So what you're looking at here is, say you're looking at a $5 stock that might have been trending downwards. You might see the price that someone's put in that they're looking to buy. And then you'll see how many shares there are. All right. How many shares are trying to be bought at that offer, right? So here you see there's $5. And they're trying to buy 100 shares, 100,000 shares, and at $4.99, someone's trying to sell at $5K. Now, this is what we would call very shallow or low market depth because there's not a lot of traders on here. If you were to open up the level 2, and that's a very important feature, all right, a lot of people don't talk about it, but level 2 is a key feature. That gives you access to the order book. It allows you to see this platform right here live on your screen for any stock on the market, and it literally tells you how many people are buying, how many people are selling, and at what price. Okay, and then something that runs along the order book is something called a ticker tape, all right, or a tape. So if you ever hear someone talking about reading the tape or the tape ticker, anything like that, they're referring to the actual real-time transaction history of these stocks. And what I mean by that is the tape, essentially, because back in the day it was an actual tape that was outputted from the stock market exchange and the hardware they used to use there. So it used to actually tell you, okay, this stock got bought at $5, stock got sold at $4.99, $4.98, $4.97, and it would tell you the actual orders as they were happening. So nowadays it's still available and you still get access to it, but you have to make sure you ask for level 2. And a lot of the times for starting brokers and for new traders, this isn't readily available for you. So you have to actually, after you set up the software, you might have to hit their customer success or service up or give them a call and they'll activate it for you, usually for free or for a very low fee. They don't make it public because a lot of traders, fortunately for us in the penny stock markets, don't even know that they have access to level 2. And this is really, once you understand level 2 market depth and the order volumes, that's pretty much puts you ahead of 95% of traders in the market. All right, retail traders are not utilizing their technology. They're not using the features and benefits that are provided to them through their trading platform. And so you definitely want to make sure you're doing that. Okay, that's how you're going to get the edge, and that's what we need in the penny stock markets. That's really what allows us to succeed because we're not up against Wall Street. We're not up against the billions of dollars invested into high frequency trading software and algorithmic trading. All right, you're not going against machines and AI who have just billions of data points that they can kind of automatically quickly move the markets. You're just facing other retail traders like you and I. So when you get a competitive advantage like this, like having level 2 and understanding market depth, this puts you in an advantage to be able to profit from the stocks. So essentially, let me tell you what you're looking for when you're looking at the market depth or the order volume right here in the, let's call this the book, right? This is the order book. I know I wrote it there, but yeah. So essentially what you have here is it's going to tell you how many shares are being bought and how many are being sold. And the reason it's important to look at is because this will tell you what direction the stock price is going to move. All right, it's just constantly like a tug of war battle between these two guys. And so obviously, I think intuitively, you can even tell here that when you see something like someone's trying to buy 100,000 shares and you see people only trying to sell, maybe at $5 or trying to sell maybe 10K and maybe at 501, someone's trying to buy 10K, right? When you see these sells and these orders, what's going to happen is you can look at the big blocks. You're looking for the 100Ks, the 50Ks. Because what happens is that usually at those points, the price of the stock will end up moving because somebody made so many, it's called hitting the bid. All right, so what's happening is that if you're buying so much and you're hitting the bid, and again, it can be used kind of differently, but if you're constantly buying, then it's going to keep on hitting where it's supposed to for the stock exchange, and you're going to be able to profit off of that by knowing the direction in which it's going. Right, so just looking at this example, when I see 100K on the buy side and only like 10, 15, 20K on the sell side, as long as the prices match up, which they're pretty much around the same, the $5, $4.99, then I can tell that the stock price is going to go up because someone's trying to buy it at $5 and they're going to propel through the stock. On the same way, right, if I was on the sell here and instead of this $4.99 being 5K, if it was 500K, now all of a sudden I would think that the stock price is going to go down because so many people are trying to sell, and that's when you can use the hitting the bid. So many people are trying to sell that it's going to cause the price of the stock to go down. And that's what the important formula is. You have to understand that the stock market is just an electronic algorithm, right? It's trying to match buyers and sellers. And there's a software running behind it that pretty much tells it that once there's enough demand for a certain stock at a certain level, it's going to go in that direction and it's going to get to it as soon as possible. So that's why the market spread is so important to know because when you're looking for stocks to sell and buy and sell for profit, you need to understand that the level 2 or the order volume will let you know whether it's liquid enough for you to get in and out of your transactions. So going back to my prior lessons or what I teach at InPennyStock University, you want to make sure that there's a good volume. And usually I'll put that at least 100K, right? So that'll be a metric just like, the high, open, low, close, dividend yield, market cap, all those little kind of features or stats you see under a stock. One of them will be volume, VOL. And you want to look out for that and you want to make sure it's at least over 100K. Could be maybe 75K if you're comfortable with the stock and you've traded it before, because trading volume is constantly fluctuating. But generally speaking, if it's lower than 100K, you're going to have some lag or some levels of difficulty getting in and out of your trades. And that can be dangerous because you could potentially be profiting but can't get out of your trade, and then the stock turns against you and now you're in the red, which means you're losing money because you weren't able to get out of the stock position in time. So definitely, keep an eye on that. And then lastly, I want to get into one topic which is important for here, called low float stocks. Okay, so a float generally has to do with how many shares are outstanding for a certain company. And I'll explain what I mean by that. So float means number of shares, okay? And so let me explain a concept to you guys, where when a company goes public, right, they take the company and pretty much all of its shares are now on the public markets, right? But some people have already have reserved percentages, right? The management team might be holding 30%, right? So let's say you have 100% of the stock, right? The management team has 30%. Let's say institutional investors, so big companies, have another 30%. And so that's 30%. And then let's say 5% is locked up, right? So lockup can happen for two different reasons. A lockup basically means that the people that are currently holding the shares of that stock, they're not able to sell it even if they wanted to. And that happens really for two reasons. One, if it's in a retirement plan, right? Your pensions, your pension funds, your 401k, stuff like that, those are usually put in as reserve stock to the mutual fund that you invest through, right? Through your 401k or pension plan or whatever. And so some of those shares, they don't actively get traded, so they're held up and they'll be included in this 5%. The other portion, which is a bit more common, especially with more recent IPOs, is called a lockup, which is when, if you go public with your company, insiders, in order to avoid like market manipulation, they are usually required to hold on to their stock for say 60 days, or actually it's more like 6 months or a year or even 2 years or sometimes longer, depending on their contract. But those, again, because those shares aren't available to be bought or sold, they're considered restricted and they're locked up. So you have 100%, right? Every company has 100% shares, obviously. And then you have 30 for, you have 30 saved up for the management, you have 30 for the institutional investors, and you have 5 for the lockup restricted. So this all comes up to 65, so you're left with 35%, right? Now this is a pretty decent float. It's a little low, but basically the reason float is important is because essentially it tells you how many shares of that stock are available to the public. All right, so how many shares are even trading and available for trade in the market? Right? That's important to know, because if you understand what I was talking about with the order book and the fact that we're dealing with an electronic algorithm, and that whatever people tend to do, whatever activity they're doing, whether they're buying more or they're selling more, will influence the price of the stock, then what that also means, logically, is that if you are to buy a certain amount of shares to a company that only has a small amount of its shares available, then your buying or your selling will have more of an impact on the stock. Okay, so I'll give you guys a clear example. Let me clean up the board here a bit, but I'll just put it in a perspective where you can easily grasp it. I'll wipe the rest. I hope you guys can kind of see this here. But basically, if you bought 10K shares of a company with 1 million shares, right? That's a certain percentage, right? You're influencing the total amount of shares by, let's say it's about 1%, okay? Now though, if you were to buy 10K shares for a company that only had 50K shares outstanding, right? All of a sudden, you have now made an impact on the stock market of 20% of the total amount of shares. Now, obviously, this is exaggerated, but I'll tell you what numbers to look out for. But generally speaking, here, you're going to make a much higher impact when you're controlling 20% of the market versus just 1%. I hope that makes sense. Rewatch this, kind of internalize it. But, again, you have to understand the stock price is influenced solely by how many people the price will go down. So just make sure you're wary of that. Okay. I want to give you guys a good resource here. I use this resource called lowfloat.com, and we're also going to make this available soon at InPennyStock.com. But lowfloat.com is a really good resource where you can actually find companies and they'll tell you how many shares they have available and how many are kind of outstanding, so you can figure out what the float is. Because low float stocks are more volatile, and you should be wary of that. All right. At InPennyStock.com, what we're going to be teaching also is how to use this information for your benefit. And we also go into more depth about, similar to how you will look at low floats, we talk about how to look at how many stocks are being shorted. And that's a very important terminology that we're going to either cover later, or we have some modules on it at InPennyStock.com. So check it out there. And that kind of wraps it up for today's lesson. We do have the live chat, so if you have any questions and you're watching, please feel free to drop in a comment or a question if you want it addressed. But we do have two from students that have kind of emailed in or DM via social media. I don't know if my team picked it up, but yeah, what's the first question?
Are penny stocks worth the risk?
Are penny stocks worth the risk? That's a great question, right? And that's for you to understand whether or not that's a yes or no. I'm going to just lay it out to you guys yourself, and you can make that decision. All right, because penny stocks, what they allow for is a high level of income for a low level of risk, but only if you do it right. All right, and the thing is that there's a lot of naysayers out there on the markets right now and just in the public who have had poor experiences doing their own trading, and so they kind of try to tell other people that it's not worth it or it's volatile. But you know, there's this one really great guy online. His name is Gary Vee. I'm sure you guys heard of him, but he kind of talks about how, you know, for certain people, the ROI or the amount of money that you can make, for example, from a basketball, from like, say, LeBron James, is obviously he can make millions of dollars with it. If you put it in the hands of someone like me or you or someone who doesn't play basketball, you're not going to make any money from it, right? So it requires skill, it requires talent, and the way you build skill, just like with anything, is practice, research, studying, and doing. So you have to constantly refine your skills, and that's how you can make penny stocks worth it. But the whole other reason, right, is just because of the amount of profit that can be made. All right. So for example, if you look at, I'm trying to think of a stock to share, but let's just go with Apple, right? It's not the best example because we're in a bull market, but Apple, for example, if you buy it in a year, you might make 20% on your money, which financial advisors and planners and wealth managers and Goldman Sachs and all these companies will tell you 20% on your money annually is fantastic. It's incredible. People, if you told me you had an opportunity where you can make 20%, you could probably raise $20 million in a week. It's very easy if you're able to make that type of return, right? And that's an amazing year. Usually blue chip stocks will only move up 5 to 10% a year. And that's a good year, right? So that's excluding any depressions or recessions or anything like that. Like you would be happy if you got these types of returns. Now, however, let's look at your own income, right? Say even you have nice enough cash flow, you have $5,000. In 1 year, this $5,000 turned into $6,000. Now the problem with that though is that think about in 1 year, you made only $1,000, right? It might sound fantastic, but those types of rules of these average returns really apply to millionaires. You know, those are people who are putting aside $10 million and making 20% of their money, which means they made $2 million in a year. That's a good return. But for people like us, for average retail traders, if you're trying to make some extra income, if you're trying to invest your money right, this is too slow for you. Or at least it was for me. I don't know. If this is good enough money for you, if $1,000 in a year is good, then you know you can probably be safer by just trading stocks like these and just holding them long term. And honestly, I always recommend students put at least 20% of their money aside for long-term investments. So that's still a applicable strategy. But penny stocks, right? What you can actually do is if you look at Yahoo Finance or finviz.com or even on InPennyStock.com/stocks, you can see top gainers and losers. And you can see that in a single day, you know, penny stock XYZ, that's just a hypothetical acronym, goes up 40% in a day, or goes up 33% in a day. And that's what we're chasing. That's the type of returns we're chasing, because then you can change I wouldn't even put $5,000 into it. I would put $2,000. But that $2,000, if in a single day it went up 40%, now I just made another $800. So I'm at $2,800 in a single day. And again, this won't be your average day, but if you hold it over the long enough time, this type of income and profits is sustainable. These are the type of money and income you would be able to make. All right, so I see we have a question here on the live. Can I trade penny stocks if I have a full-time job? Great question. So that's actually one of the major ways that people actually initially get involved with stock trading. All right, what they end up doing is, you're working your job, you're finally making a decent income, you have some savings coming in, and now you're being smart and you're thinking, okay, I always knew in school, I heard from Warren Buffett, these whatever kind of side things you've heard of, you want to put your money to good use. You want to have your money make money for you, right? So you should be responsible, you should do the right thing and invest your money, but now you don't know how, right? So a lot of the times we actually recommend that you start trading penny stocks while working full time, because you're not going to just overnight give up your income, give up your 9-to-5 or your W-2 job or whatever it is and get to trading. That's a dumb move. It takes months to be able to refine your skills to become a good trader. So what we recommend here at InPennyStock is we show people how you can use mobile apps, how you can trade while working full time, how you can build your watch list and set real-time alerts so the best times to trade. We have these talents and these tricks called the double catalyst rule that you can set up alerts to trigger. So at work, as long as you have the ability to maybe pull away for about a minute or for a few minutes, you can actually execute your trade and still profit. All right, and final question.
Where can I find a list of penny stocks?
Okay, so where can I find a list of penny stocks? So that's a good question. So penny stocks, first of all, they're traded on a separate exchange than normal stocks. That's why they're given the terminology penny stocks. Okay, so for example, the SEC, which is the Securities and Exchange Commission, they'll say that that these penny stocks are pretty much defined for any stock under $5. All right, so that's a pretty good vocab for it. There's a pretty good kind of threshold. But the key thing is where these stocks trade at. All right, so you've heard of the NASDAQ, you've heard of the New York Stock Exchange, I'm sure, right? Those are pretty popular. They're in New York. They're where all the big companies trade on. Apple, Facebook, Netflix, Google, Amazon, Twitter, all those public companies trade on either the NASDAQ or the New York Stock Exchange. That's where the big companies trade. Penny stocks, on the other hand, trade on different markets, and they're known as either the OTC, which stands for over the counter, and pink sheets. Okay, so these are the different markets upon which penny stocks trade on. Now, you have to be wary of this because when you're setting up your trading account and you're looking for a broker to use, a lot of the times they're just going to be referencing NASDAQ and New York Stock Exchange. For example, Robinhood has these. They don't have, or a lot of trading platforms don't have, or you have to request specific access to the OTC and the pink sheets markets. So that's how you'll get access to them. But I'll give you guys a great resource here. Sorry, it's called OTCmarkets.com. That's a great resource for you to be able to find pretty much all the penny stocks you're looking for. Right? And then at InPennyStock.com/stocks, you can also pretty much search and filter through. Might as well throw the plug. Final question, actually, I'm going to be reading from the live. I'm currently traveling. First of all, thank you, Jake, for showing up and asking questions. I'm traveling right now. Do I need to be in the United States to trade penny stocks? Great question. So although the exchanges are live in the U.S. markets timing, right, 9:30 Eastern to 4 p.m. Eastern, that's how the markets trade. But you don't need to be in the United States. Right? Thank God, because of online, as long as you have internet access and access to your trading platform, which is usually on a website, which you would require internet for, you can trade anywhere. And you have to trade in those market closes. So whatever time it is overseas, when I go overseas, technically I'm looking at the stock market at nighttime there. So it might be midnight, and China might be overnight where the US markets are open. So you will have to adjust your timings, but fortunately, you're still able to trade and execute trades from wherever you are. You just need your laptop or your phone and an internet connection to be able to input your orders. And honestly, if you wanted to, I know a little bit more of our older generation traders, what they tend to do is they're still reliant on their broker. They just have a long-standing relationship with them, and they've served them in the past. So you can still call up your broker if you want to execute a trade. Kind of an old school, slower method, but it's available for you if you need it. Wi-Fi goes out, but your phone's working. Maybe you can pull that in if you need to. So just something to keep in mind if it ever comes to it. So yeah, thanks you guys for joining. We're going to be doing this again tomorrow, same time, 8 p.m. Pacific, 11 p.m. Eastern. Come ready with your questions, any advice you need, any stocks you're looking at. We'll kind of put it together here on the live. So hope you guys enjoyed. If you have any questions, you can always email me and my team at admin@InPennyStock.com, or you can reach us on our social medias at InPennyStock, Twitter, Facebook, YouTube, everywhere pretty much. So always available. We're here for you guys. Hope you guys enjoyed this, and I'll see you guys next time. Take care.